So, the next big question is when we're thinking about building out portfolios, where can investors look for higher risk adjusted returns? So, I'll start out by highlighting some of the dynamics that we've been observing from a cross asset class perspective. The first one being bonds starting to act like bonds within portfolios. In this graph, you can see how stocks and bonds are not as positively correlated as they've been in the past. Correlation just referring to how the prices of these two asset classes move in relation to one another. And right now, if you see, we're effectively close to zero, still nowhere near 2010 levels where there was this perfect negative correlation, but not what we saw in 2022 when stocks and bonds were both getting crushed. If we go on to the next slide, another interesting dynamic that's been taking place is the diversification benefit international stocks have had in portfolios year to date. Here in this chart, we once again look at the correlation between US stocks and international stocks, which has come back down. So, for many investors this year, being globally diversified has finally paid off, which is one of the biggest reasons of when we look at a 60/40 portfolio, the performance year to date looks pretty solid. What we're showing here in this slide is that despite the massive drop that we had in April, if you held 60% in stocks and 40% in bonds from the beginning of the year till now, you'd be up 6 to 6.5%, which is actually not that bad. If we take a step back though and just look at where we stand today with valuations creeping up, the dollar being over in this oversold territory, which may potentially not act as much of a tailwind to international stocks, credit spreads continuing to be in this tight territory again, growth projected to slow down. All these things make us wonder how easy will it be to repeat this for the rest of the year? So we go into the next slide. If we take a look at where we are headed into the second half of the year, we continue to view the market environment to be somewhat muddy. With that in mind, we're maintaining a neutral stance across both equities and fixed income. And we continue to believe that broad diversification will continue to play an important role into the second half of the year. Mike Goldstein from Empirical also pointed out we aren't really getting paid to take on a lot of big bets or really do anything right now, which naturally raises a question of okay, what can we be doing across portfolios to add value? And in our view, the most compelling opportunity continues to lie within alternatives, where we remain overweight and where we continue to see the greatest opportunities to really generate that additional alpha within portfolios, particularly through strategies that offer uncorrelated return streams or can capitalize on market dislocations. So, if we go into the next slide, I'm going to just quickly recap some of the comments that Kevin and Brian and Jay walked through. Just starting off with fixed income, like I mentioned, we remain neutral, continue to prefer municipal bonds just given where yields are at on an after tax basis. Credit spreads look pretty tight still, meaning we don't think investors are really getting compensated to take on extra risk there, which is why we maintained our up in quality bias, leaned into high quality securitized credit with a preference for investment grade over high yield. If we turn over to equities on the next slide, you can see here that we're neutral across the board. Despite growth being potentially weaker and lingering policy uncertainties, companies continue to report strong earnings. Investors' positioning remains favorable for US large caps. There's a lot of still optimism around the structural growth themes like AI that should support profits and valuations in the near term. Globally, we acknowledge, as Jay mentioned, that we've had this big outperformance within international stocks, and we would just caution a more patient approach when adding to the asset class, just given how oversold the dollar is. And one common theme across all segments of the equity market is we do continue to preach quality companies with strong balance sheets, earnings resilience, and positive cash flow generation. Lastly, just turning on to alternatives in public real assets. As I mentioned, this is an area within portfolios where we do have a ton of conviction in right now. It really can be expressed in different ways across portfolios, depending on the risk or liquidity tolerance for different clients. But broadly speaking, across private markets, we're very optimistic that these new vintages are going to be able to capitalize on any opportunities from an economic reset. Areas of opportunities really lie within venture, private lending, infrastructure, uncorrelated private strategies. These are strategies we can think of where their return stream isn't going to necessarily rely on the path of the Fed or equity markets to do well. Volatility strategies is another area that we really like. These things like structured products, where investors can capitalize on volatility and consistently achieve equity like returns with 30 to 35% downside protection. And then lastly is we do keep our underweight to public real assets. We believe there are better ways to hedge against currency depreciation and higher inflation than holding REITs, commodities, publicly listed infrastructure that tend to behave a lot like equities, which is why we would lean more towards private, less liquid infrastructure within our tactical views.